Hi guys, I'm Ryan Mack and welcome back to another episode of The Trading Guys. Today I've made some notes here. I'm going to be teaching you, or running through with you, backtesting. The difference between historical backtesting and live backtesting, or some people call it hot backtesting, which means that the market's currently moving. And I'll also be covering with you, for beginners, how to do what's called paper trades. A paper trade is essentially when you sit here at the desk, and I mean you may have a live account or a demo account, whatever, but let's say it's a live account but you're still fairly new, so you're a little bit anxious and nervous because you're like, oh my god, I'm really losing money now if I have a losing trade, you know. And you know what, you don't have to be losing $150 in one trade to feel, oh my god, I'm losing money. I mean, when you first start out trading, when you lose $2.50, you still feel terrible because you're still like, oh my god, I'm losing money. It doesn't matter if it's $2.50 or $250, you still feel that kind of feeling of nervousness, anxiety, worry, and this is all normal. Trading is not the hardest part. The psychological part of trading is the hardest part, and it's why many people who could have been very good traders fail. It's not because they don't know how to trade, it's not because they don't know how to read the charts, it's because they haven't mastered how to handle and suppress their emotions while trading. That's all it is. It's the hardest part. It's 70% of trading is the emotions, maybe even more. So today I'm going to be showing you a technique which can actually help suppress your feeling of anxiety, and that's essentially to boost your confidence. Pardon me, to boost your confidence, how would you do that? You do what's called backtesting without having to lose any money. Backtesting is where you look at the chart and you scroll back the way, like this, and you look for patterns that you look for as indicators, and you write down on your notes, okay, I can see here on GA a couple of days ago it gave me a single bottom, it gave me a rejection at the bottom, it gave me engulfing candles, which is a great indicator. Oh, if you look here, it was also massively oversold, so it's massively oversold, it's given me two engulfing candles. Oh, this is great. So you're writing these down as indicators, and you can have a look at what else it done. So let's have a look at the M15. Let's see. Oh, here it is here. What else was there? Oh, it rejected bang on the straight after the pre-London. This is called pre-London, this grey bottom. So it rejected on pre-London. At pre-London, it normally goes the opposite direction to what it's previously ran in the Asian session. So if it's been running short at the Asian session, when you get to pre-London, of course, not 100% of the time, because that never happens in trading, but more often than not, especially in GA and GJ, it will run the opposite direction in pre-London as to what it already ran in the Asian session. So yeah, look at that, it's double bottomed right at pre-London. There's a third indicator for me. Is there a fourth indicator? Yes, there is. If we look here, this is massively oversold, but if we look here, it comes down to roughly the same region to reject, and it's also at the oversold line here where it pulls back for that rejection. So there's a fourth indicator for me that is going to run long, and I would then take that trade running long, you see. So this is backtesting. This backtesting is called historical backtesting, which means I'm swiping back and I'm going through the history of the trades to see what's happened. So we're looking here, look, comes down, massively oversold. It gives you a double bottom here, rejection, and then it starts running long. Oversold, starts running long. Is there another indicator here? Yes, there is. That other indicator is the fact that if you look here on the screen, you can see that it gives you a rejection here. It then gives you a second rejection, right, which is bang in line with the first rejection. However, if you look at the TDIs here, you will see that the first rejection is massively oversold, right? But when you look at next to it, where this is at the same level, and it should also, in theory, be massively oversold down here, it's not, it's higher. So this down here is higher, even though this down here is at the same level. That's what's called divergence, and that then tells me that this divergence is running long, because this is down at the same level going low, but this is actually higher down at the TDI/RSI lines. That's divergence. That tells me that that's also going to run long. It's another indicator of this going to run long, okay? And then you have the candle pattern here. I forgot the name of this. What is it? That is... You could call it a dragonfly doji, I wouldn't call it, or you could call it bullish engulfing. A bullish engulfing, that's fine, because it is a bullish engulfing, and it runs off and goes long. And you can see here over this is an older markup. Sells below here, buys above here. Let's have a look as we continue to backtest, or let's just look on a different currency pair so you can see. So this one here is GJ. Look, it's absolutely flown today, but it still hasn't really passed this rejection point here yet. I don't trade Fridays at all. And look, so let's have a look at this here. One of my golden rules for not taking a trade is that I will never ever ever enter a sell order if the market is already oversold, which it is here. I will never enter a buy order if the market is already overbought. Now, just to clear that up, you may get into the region here. Let me make this bigger for you so you can see it. You may very well, look, this blue line represents the market, and if it's past the blue line, it represents being oversold, okay? Now, you may very well get a market that's already oversold and it keeps running oversold. That can happen. Anything can happen in trading. However, that's not the highest probability. The highest probability is that if it comes to the oversold, look at this here, bang, oversold, it will then reverse and go long. Oversold, it then ran long, right? Look, and the same with overbought. If it's overbought, I will never enter a buy order because, excuse me, the highest probability is that it's going to start going short. It can keep going long, but that's the lowest probability that it will keep running long after it being oversold, overbought, okay? And if you look here, backtesting historically, look at this right here, look. Overbought, tanks and goes short. You can see overbought, tanks and goes short. Oversold, rockets and goes long. Oversold, rockets and goes long. You see, now let's have a look. Does it keep happening? Let's have a look here. So I'll make this a little bit smaller. Massively oversold, should in theory go long, goes long. Let's have a look. Let's make this a little bit smaller for you. Now look here. Here's a perfect example of it not working in your favour. This is overbought. Yes, it does come back down, but then it flies off and goes long again. So this is what I'm saying. Trading is not 100%. There is no method in trading which is 100%, alright? It's all based on highest probabilities. But if you keep going back, the highest probability of the times when it hits oversold, when it hits overbought, you want to be looking for sell orders. Doesn't mean you're going to enter, because you can't just trade based on that. You have to look for other different indicators. But the highest probability is that it's going to go long. If you look here, it's giving you a double bottom. I know that's quite small, sorry, hold on. It has where is it? It's giving you a double bottom right here, and it's also massively oversold. So there's two indicators right away that that's going to run. The third indicator would be this candle pattern here, which is an engulfing candle pattern. It engulfs. As soon as my entry would be anywhere around these candles here. Alright, that would be my entry to take it long. I would then close 80%, move my stop loss to break even, and leave 20% as a runner. That's it. If it doesn't run and pulls back, who cares? I've already secured 80% of my profits, okay? So let's continue. Look, nearly, it's not quite, but look, you can look at this here. This says it's overbought here, and it doesn't tank and go short. So that indicator didn't work. Oversold goes long, oversold goes long. Massively oversold goes long, oversold goes long. Oversold goes long, oversold goes long. Oversold goes long, you can see it here, it goes long. So it does pan out, you see. There's been one occasion so far where it hasn't went my way when you thought it's going to go oversold or overbought, and then it hasn't ran. There's been one or maximum two occasions in these examples here where that hasn't panned out, but it doesn't matter because, so far 80% of the trades that we've just looked at very briefly here have panned out in our favour, just off that one indicator alone. Now, of course, you would never just trade off that one indicator, that one thing. There's many other indicators that you have to incorporate, but you can see that it is a pretty effective indicator in way to look. All right. Yeah, and that is essentially how it goes. Now this is what's called historic backtesting. This is giving me a lovely double bottom here, as you can see. Plus, look, boom, oversold, double bottom. That's a massive indicator for me. Rejection. There's 3 indicators right away that's going to fly, and it flew. I think I actually did get around 85 pips on this trade. I did actually. I could have got more, so I can tell you where I got in. I'm going to show you it. I remember this. I actually got in this trade right here, in the middle of this candle running, which you shouldn't do as a beginner. You should always wait for the candle to end, but I was like, yeah, I was happy with my risk. I was happy it was going to go, blah, 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 just because I've been doing it for so long. And I entered around here. I actually got out of this trade here. So what happened was, I can explain, as this third candle flew up here and it came to this rejection point, I closed 80% of my trade. So I'd already banked, 80% of my money here in these 3 candles, or 2.5 candles if you want to call it that. What I did was I moved my stop loss. My stop loss was after this first candle here. I had already moved my stop loss to break even. So if this came down and whipped against me, I hadn't lost any money in the trade. I hadn't gained any at that point because I hadn't closed any. But the important thing is, if it pulled back on me, pardon me, I would not have lost any of my money, alright? It was a free trade. Essentially, after 1 candle, it was a free trade. What happened was, when this came up and closed here, when this came up, this candle closed, I closed 80% of my position, and I moved my stop loss from break even up to in profit, which is, I moved it up to here. And then what happened is, this candle pulled back, stopped me out, and then it ran, which was stupid on my part. What I should have done was, I should have moved my stop loss to the previous last candle, but that was essentially just a little bit more than my break even. So I thought, bugger it, I'm going to put it to the top of this candle, and it came back and bit me in the ass. It's done that plenty of times before. That's my mistake. Yeah, well, that doesn't matter because I already made my money, so it doesn't really matter. But that was why it happened, and that's why I didn't catch this full run. You always try and kick yourself. Oh, look at what I could have had, Hey, it is what it is. You learn from your mistakes. So from now on, unless it gives me a consolidation and a continuation run, before this consolidation and continuation run happens, I now, as part of my rules, keep my stop loss at break even. I don't move it to in profit. I keep it at break even, and only when it passes up for continuation run, I then move it to in profit. All right. So that's essentially how it works, and that, ladies and gents, is an example of where's the bloody market now? That is an example of historical backtesting. Okay, we also have live backtesting, if that's what you want to call it. Some people call it hot testing, and that is essentially doing what's called a paper trade. All right, a paper trade is you sit here and you look at the screen and you say, right, if this comes back up and it gets rejected here, I would take it short. And as this pans out, you see this here, and you get in for a short trade here, and it runs short. But what you do is, you don't physically take the trade. You simply open up your book and you write down the notes on the trade. So you're going to write down pound yen. You would then say, I'll just write it. I'll do it, a picture paints 1,000 words. You write GJ. Looking for sells. Okay? You then write down the directional bias is short. So DB, directional bias, is short. Is it a trend, which is T, or counter trend trade? So in this occasion, it's going to be you're looking for a trend trade. What next? Indicators. What indicators can I see on the screen that tells me that this is potentially going to be short? Well, it's already given us a massive run long. It's been running long for ages. It's then rejected and given us a double top here, perfect double top. So we have a double top reg, which means rejection, which is one indicator for me. It's already gives a pullback, which is a great little indicator for me. Previously it was overbought, so previously overbought. It's not now, but it previously was overbought. So it's now massively oversold. So at this point, just so the camera knows, I would not be entering a sell here. Now look, there will be plenty of people that will enter a sell here. What I would essentially be looking for is I want to see it come down. I want to see it pull back for a retest and get rejected here and then get in the sell. I would not be entering a sell here to take it short. Now, I could be wrong and I could lose out on that. So you would say, well, look, there's clean range to the left. I absolutely know that. And if it breaks this previous support resistance, why wouldn't you take it short? Well, the reasons why I would not be taking it short right now is that you can get what's called, sometimes the market maker pushes it to trick breakaway traders. You get people who, the minute this breaks away from the previous support and resistance, they will enter a trade. So the market maker knows this, so he will give you a candle running, right, to initiate breakaway traders to enter this trade, and then he'll pull it back and hit the stop losses, and then he'll continue the trade in that direction anyway. Number two, this is massively oversold, and as part of my own personal trading rules, I never enter a sell order if it's already in the region of being oversold, and I never enter a buy if it's already overbought. So this is already massively oversold, therefore it means the highest probability here is for a pullback, which is what I'm looking for. I want to see this break down, I want to see it pull back and then get rejected here, and then I would take it going short. I just would not take a sell at this moment in time, even although we have clean range to the left, okay? And that's just my own personal preference, because I follow my rules implicitly. There'll be many of you who are brand new thinking, well, can it just run and you've missed the trade? Absolutely. That could just keep melting right now past here and I could have missed that trade, and that's fine. My rules are, it's better to miss a trade than lose a trade, alright? I would rather miss that than get in, trying to be greedy and get in at early pips and then lose it because I've ignored my rules of don't ever enter a sell order if it's already oversold. I just don't do it. So what you would do is, you would write down all these different things that's going to go. You would mark down your price that you would have entered based on, so let's say the price I would have entered is 167311. Just write entry 167.311. 331, sorry, 331. Your take profit would be at your first take profit. You can have multiple take profits, but the first time you would take profit is going to be right here on that previous support and resistance mark rejection, so which is 166702. So TP1, take profit 1, is 166702. And at this point here, I would then close 80% of my position, and I would move my stop loss to break even, and I would leave 20% as a runner. So let's have a look at how many pips that is. That is roughly, oh god, that gives you a clear 70 pips to make profit. I mean, that's a fantastic trade. You wouldn't even have to trade after that. You could, if you got in late, you could just close out your whole trade. However, I wouldn't. And that's essentially what you do. You then come back to it later on, or you can sit and watch it and see how it played out. And then what you do is you just right beside it, win. And you put a tick, or you can mark it with a green highlighter if you wish. And then what happens is, the next time you want to do a trade, you just write it in again, GA. So that would be pound Aussie dollar. And you then go through the same system. Let's have a look. You then go through the same analysis for pound Aussie dollar. Okay, if it breaks this line here, I'm going to take it as a sell. My first take profit is going to be this last rejection. That blue should be a bit higher, which will be 174809. That would be my first take profit. And that's you just essentially write that down, and you come back to it later and you see, did it pan out? Oh no, it didn't pan out. It actually came down to here and got rejected and flew off. So you can put down loss. Obviously in this case it would have been a win because we can already see it. So you would put down a win. And what happens is, if you do that for 2 trades a day consistently for, let's just say, 2 weeks, where you do not trade any live money, you simply take paper trades. You sit here and watch it. Do not be tempted to jump in the market and take it. You have to do the experiment the whole 2 weeks, because at the end of the 2 weeks, you're going to look back at all your trades and be like, right, I've taken 24 trades in that space of time. How many have panned out? Holy shit, 21 of them have panned out and I've had 3 losses, or 18 of them have panned out and I've lost the remainder. But at least at the end of that, you then build your confidence in trading. You're like, wow, out of these 24 times that I said, okay, it's going to happen because of this, because of that, 18 of those trades have came in, and only the remainder up to 24 hasn't came in. And it's like, wow, that is absolutely phenomenal, guys. And at that point, you can then enter trades confidently. Now, if you are, here's another point. If you're entering trades and the minute you enter a trade, you feel like anxiety, you feel worry, you're like, oh, you're panicking. The minute you go into a little bit of drawdown, pardon me, what that tells you right away is that your risk is too high. Even if you're just risking 2%, if you're panicking when you're in a trade, your risk is still too high. It might be the risk is too high for the amount of money you have in the trade. It might just be that your risk is too high for your experience level. Maybe you just have a lack of experience and therefore you have a lack of confidence and therefore you're panicking, so you're not really trading at this point, you're still just gambling. And that's fine if you want to enter the market, but what I would recommend is, instead of entering the market at 2% right away until you've built up your confidence and your level, then just enter the market at 0.5%. Just break your risk right down. You should be able to place a trade and turn your computer off and go to sleep. That's once you can get to that level, you can place a trade, switch your computer off and go straight to bed and sleep without having to wake up every 2 seconds looking at your phone, wanting to see if you're in profit or whatever. Then your risk is too high. Okay, if you can go to sleep, your risk is perfect, and that's how you know. Okay. This is a very simple video again, but I hope it's very useful for people who are beginners in Forex, because it really does help. Thanks very much for watching. If you have any questions, you can put them in the link. You can put them in the comments below, depending on what social media platform you're viewing. If you're watching this on a website, then you can hit us up at The Trading Guys on any social media platform, Facebook, YouTube, Instagram, Snapchat, TikTok. We're on all of them. You can also hit us up if you wish to join our community and you want to learn from us, and you want to receive the same trades that we place at the same time. Like I said in all my videos, it's not signals. I hate signals. What we do is we send setups. So we will say to you, we will show you on the screen, okay guys, here's your support resistance lines, what we're looking for on pound Aussie dollar today. If you get a 1 candle close below this, you're going to then be taking that as a short, and you could then enter the exact same trades that we place. And that then means that, let's say we're busy doing something and we ourselves miss this trade, because we've already told you the setup, this is what we're looking for. It doesn't really matter if we give you the full-blown signal and say, right, I'm in now. We've already told you what to look for, so you can enter this trade comfortably yourself once it passes the kind of criteria that we've already set within the group. We call it earn while you learn. So we give you the exact same trade setups that we use and tell you when to buy, when to get out, blah blah blah, so that you can make money on trading while you're still learning from all the videos that myself, Lee and Ian have created for you. Alright, don't forget to hit us up at www.thetradingguys.com. I'm Ryan Mack. This is The Trading Guys. Thanks very much for watching. I hope it's been very useful for you. Okay, speak to you soon. Bye bye.